the horror story, the cost of selecting the wrong investment advisor. And I'll give you a situation that actually happened to me. Had a client that sold a very large business, very charitably inclined family, and put a significant amount of money into a private foundation for the family, and with very formal processes for all the kids to participate in education and all those things. And we went through this process and actually hired a consultant, a true investment consultant, not affiliated with any brokerage firm, not managing any money, out of Chicago. And we thought we did a good job in working through it. Over the next couple of years, within about 2 years, one of the family members who was actually the treasurer, one of his buddies was more of a retail broker at a very large firm that's been in the paper lately. In fact, I think it was Jeff's alma mater, started whispering in his ear saying, hey, we can do a better job for you guys. We can give you lower prices. We can get you a better return. Let me take a look at your portfolio. And they came back with this analysis. And unfortunately, and understandably, the client made the decision to make the move. They were hearing about, well, geez, I can tweak this return, and these people are going to get me better pricing, and my fees are going to be lower, and those kind of things. So what ended up happening? The first one, conflicts. When you go to a large brokerage firm, depending on who you're working with, keep in mind they're oftentimes selling their own product, and unless you clearly understand it, they're going to be trying to push you into their own products because that's where they make more money on a transaction. So one of the absolute first things you ought to be looking for in an investment manager is somebody that's conflict-free. Or if they are conflicts, you better make sure you clearly understand what those conflicts are and make sure that you're comfortable with them. It may be that an investment manager has their own investment advisory service where they're actually managing the money on your behalf. You ought to know why they're steering you toward their own investment advisory services rather than going out to, maybe it's a mutual fund, maybe it's an index fund, maybe it's an independent mutual fund, for example, a Fidelity with extremely low fees. Make sure you understand that. Ill-considered and poorly implemented investment policy. By the time we figured out what was going in, and actually one of my charges was after we had this disaster, I was asked to go out and find a new treasurer, outside family member. We actually found a great one who was affiliated with one of the universities here, and he was able to get in and did a lot of analysis and came back and said, boy, this investment policy, it's a good investment policy, they've got it so screwed up with the different classes of assets. It doesn't, what your pie is supposed to look like, it isn't there. So you need to make sure that we go back and let's get this thing moved, and let's make sure we reallocate and get back into our proper slices. Complex and mischaracterized products. One of the slices on their chart, their investment allocation chart, was fixed income. And one of the things that this broker did said that, hey, we've got this product that our firm is sponsoring called a collateral mortgage obligation. And it's a fixed income. These are bonds. Don't worry. And it gets you a higher return. You're going to love it. It turns out, if you've read about collateralized mortgage obligations lately, what they do is they take this bundle of all these mortgages that are out there. And in fact, the most recent one that's been in the paper is this idea of they actually did this with the idea of causing it to fail because people were shorting these things. But what they do is they then slice up this portfolio of all these mortgages into pieces, sort of the cream of the crop that's always going to get paid out is there regardless of what kind of failures you have. And then the very bottom to say, look, you're going to get a high return down at the bottom, but if things go bad, you're going to be the first one to not get any payments any longer. So for a period of time, it looked great. The portfolio was performing, but as soon as things started to take a downturn in the mortgage market, all of a sudden, these things were worthless. And you've seen tons of articles about school boards and others investing in those things, and they were being sold as safe. These are fixed income. You're going to be able to get more money than you could if you invested in bonds individually. This goes back to, I think in Jeff's conversation, talking about Charlie Munger, talking about make sure you absolutely understand what you're investing in. a key point when you're eventually picking your investment manager, advisor, and going through it. And Warren Buffett, getting out of the derivatives. He didn't want them because he didn't understand them. I challenge anybody here to say that they can say, yeah, I absolutely understand what a collateralized mortgage obligation is, and I understand the various tranches and the equity piece. These firms, because of the conflicts, they were selling these equity tranches in these things to unsuspecting retail customers. I mean, that's what they were doing, and that's why you're seeing all the lawsuits associated with them. And what I say here is hidden fees, while they're saying, well, I got a great wrap program, we'll take all your fees, we'll do the trading for you. When you start to unbundle all this stuff, very expensive. And if you're trying to beat the market, which is really tough to do, and there are fees in there, even if they're a point, you're just not going to be able to do it. So you understand what your fees are when you're talking to investment advisors. And I say the last one on here: fraud at worst, ineptitude at best. You've got the Madoffs and these other Ponzi schemes which are out there, and I don't necessarily think that's the typical situation. I do think that there's ineptitude where you have these retail brokers who really are not that well educated and are being forced or instructed to sell something that frankly they don't understand. In this particular case, I don't think it was a case of the broker being a bad guy or knowingly trying to take advantage of his client. I think he really thought he was selling him something that was good, but he didn't understand it, much less the client understanding it. So an overall bad situation. As I say, what we did is we ended up hiring a new treasurer. We went through this process once again. We've got a consultant out there. We've got a new investment policy statement, and it's getting back on track. So it's working just fine. So some horror stories to start out with and what you don't want to be doing. Okay, who's out there as to who you might be able to hire? Independent investment advisor. When I talk about that, when I talk about an independent investment advisor, I don't talk about a money manager per se. This is someone that you contract with to help you put together your investment policy statement, to make sure you understand the risks and rewards of investing in a particular allocation, saying, all right, I'm willing to take this amount of risk, and I'm not going to be all over your case if all of a sudden the portfolio drops in a particular year, because I understand over a long term I'm going to be able to make what I need to be making. But in that case, the investment advisor is the quarterback in a sense. He's saying, all right, I'm going to provide the discipline for you. I'm going to provide the reporting for you. We're going to go out and find these managers to fill the slots. It might be index funds in certain circumstances. It might be bond funds. It might be individual bonds, the whole works. But typically, at least as a first cut, the consultant or the manager isn't making investment decisions or actually managing the money per se. They're helping you choose the managers. Now, there are a lot of firms out there that will say, we can fill one of those slots. We've got a very good fixed income department, and what we want to do is we'll farm these various pieces out, but we'll do the fixed income piece of it for you. That may be fine. Just make sure you understand that and what you're doing. Family office, very similar to an independent advisor, but they offer additional service. Might be bill paying, might be check writing, might be coordinating all your insurance, this whole program of, sort of you just take care of everything you want to be doing. So there's sort of a mixture of independent advisor and others. The trust company will manage money for you. They'll do it on a fiduciary basis. They may have their own products. They may be farming out. They may say, look, if you don't want us to invest any of your money ourselves, we'll put together the allocation, the investment policy statement for you, and farm it out to these various advisors. Retail brokerage firms are out there as well. Sure, you get what you get with those guys. It depends on, there are good brokers out there. They have these personal wealth departments where you maybe are raised up a little, but you're typically getting, in my opinion, sort of a push down of, all right, what is the theme we're selling today and what is the portfolio we're selling today for this particular individual. And then you have the ability to handle it on your own if you're so inclined. I've got a list of sort of the competitive landscape. I don't know if people have copies of this, but we're happy to share these with you. In the interest of getting through here, you can see the various things that different classes of advisors are offering to you. I'm going to be focusing on more just the pure investment management piece. I'm not going to be talking about insurance or check writing or anything else. So we'll sort of focus on that as we go through here. And this gets to the question of what services do you need? You want asset management? I think that's where I'm going to start with. Taxes, estate, and retirement planning? Yeah, you probably need that as well. And that's one of the things that sort of is the precursor to the investment management. What do you need? What do you have? What do you need? What risk are you willing to take? And, and how is it going to be working through there? Budgeting and debt management, might need that. Insurance planning, and custody and brokerage service. Another point to be making, when you have an investment manager, a lot of people don't necessarily understand the terms, and I don't think the terms are often used consistently. When you have an investment manager, the investment manager just doesn't really hold the assets, unlike, well, sometimes they do. Again, you look at Madoff where they were actually holding the assets. But there's typically an independent custodian. So it might be a Schwab, it might be Pershing, it might be somebody else, that they actually have possession of the assets themselves and will work through that. And they will hold them. So it's not you're actually handing it off the assets and you've got this worry about, well, what's this guy going to do with my assets? So you are going to have this independent custodian. That's one of the things that you're probably going to be looking for. And it may be that the custodian is Schwab, but your investment advisor is SVA. Let's look at the typical structure here real quick as to what I was talking about. What we would typically have is a custodian who holds the assets, a client who actually funds the custodian who holds those. You've got this advisor consultant sort of acting as your quarterback with the investment advisor and the policy and helping go out and find these different advisors to fill the various slots in your investment portfolio. And what the advisor then is doing is he's sitting down with you on a regular basis and saying, all right, here's our portfolio, here's our allocation. We want to be 40% fixed income, 60% or 50% equities, 10% in alternative investments. That's what we've got. We're going to set up benchmarks for each of those that are appropriate under the circumstances so that on a regular basis you sit down and they show you how you're doing against your benchmarks to see how they're performing. They will help to make sure that you keep that balance. There may be some tactical reallocation from time to time. But if you can get into that situation and you can find somebody you trust, you're paying reasonable fees for that, and oftentimes they can pay for themselves because they'll get you access to managers at perhaps a lower minimum that you can get in individually or perhaps at a lower cost. If you can just get that going, you can get comfortable with the advisor, you then can sort of put it on autopilot. You don't have to be watching, as these guys said, CNN every day and see how things are going, or the financial news network, or the guy that rings the bell. You know what you have based upon historical experience, what you can expect from your portfolio, and you on a quarterly basis then have the ability to sit back and make those decisions.